All right, welcome back to the deep dive. Today we're diving deep into something that I think is going to be really relevant to a lot of you guys. We're looking at some pretty big changes proposed for inheritance tax and capital gains tax
Yeah.
in the UK. And specifically, we're going to zero in on how these changes could really impact those of you out there who own agricultural property or businesses.
Mm-hmm.
Now, I know, tax talk can be,
A little dry.
yeah, a little dry. Definitely not the most exciting thing in the world, but trust me on
It's
this.
important.
This stuff is crucial, especially if you're in the ag world or running your own business.
Right.
We're going to break it all down, make it easy to understand, and maybe even a little bit interesting.
We'll try.
Yeah, we're going to try. And on top of all that, we've even uncovered a bit of a time crunch
Mm-hmm.
with these changes, something that could really sneak up on you if you're not careful.
Yeah, you really don't want to be caught off guard.
No, definitely not.
Yeah.
So before we get lost in the weeds, let's just get everyone on the same page. We're talking IHT today. Inheritance tax and CGT, that's capital gains tax.
Right.
These are the taxes that can pop up when you inherit assets or when you sell something that's gone up in value since you got it. Now, for those of you out there with farms or businesses,
That's where APR and EPR come in.
exactly. We're also talking APR agricultural property relief and BPR business property relief.
Mm-hmm.
And these little guys,
They can be real lifesavers.
oh yeah, they could potentially save you a whole lot of money on that inheritance tax bill.
Mm-hmm.
But there's a but coming, isn't there?
Always a but with taxes.
Always. Starting April 2026, we're seeing a cap on just how much relief you can actually get from APR and BPR combined. That cap's set at £1 million per person. So what that means is if the combined value of your agricultural property and business assets goes over that £1 million mark, you're only getting a 50% discount on anything above that.
Yep. Big change.
Big change.
Right.
This could be a pretty big deal for a lot of folks.
Yeah, previously you could essentially eliminate your IHT liability with these reliefs. But this cap definitely changes things, especially for those with substantial assets.
That 1 million cap, it's really kind of shaking things up. I'm wondering, could you walk me through like how this might play out for someone with a large estate?
Sure.
Say someone who owns a farm and it's worth, I don't know, £2 million.
Okay, so let's imagine this farmer, their entire estate is that £2 million farm. And let's say it qualifies for 100% APR.
Okay.
Under the current rules, they wouldn't owe any IHT because that relief covers the whole value.
Makes sense.
But come April 2026, with this new cap, only the first £1 million of that farm's value is getting that full 100% relief.
Right.
Anything over that, well, it's going to be subject to IHT at 40%.
Oh, wow.
With only 50% relief applied, meaning they could be looking at an IHT bill of £200,000 just on that farm alone.
Wow, that's a pretty hefty chunk of change. So really understanding the ins and outs of these reliefs.
It's crucial.
Oh, absolutely, yeah, and how they actually apply to your specific situation. Maybe we should take a closer look at what exactly qualifies for APR and BPR.
Good idea. Let's start with APR. It generally applies to agricultural land here in the UK.
Okay.
You usually get that 100% relief if you've been living on the property and, importantly, actively farming it
Right.
for at least 2 years before you transfer it, whether it's selling it, gifting it, or passing it down. Now, if you've owned the land for 7 years but someone else has been farming it, you still qualify for APR,
Okay.
but the relief drops down to 50%.
Interesting. So what if, let's say, a farmer decides to, I don't know, branch out a bit, use part of their land for, I don't know, holiday cottages?
Ooh, that's a good question.
Yeah, could that affect their APR?
That's a great example, and it really shows how tricky these rules can be. If the way you're using the land shifts away from purely agricultural, to something that looks more like an investment, like
Yeah.
those holiday rentals, you could see your APR go down.
Yeah.
And the same would apply to other things that might not be considered strictly agricultural, like imagine putting solar panels on some of your farmland or battery storage. Those are fantastic for sustainability, but they could potentially mess with both your APR and BPR.
Wow, that's really interesting. It's not just about what you own, it's about how you're actually using it. Okay, now what about BPR?
Okay.
What kinds of businesses are we talking about that would qualify for this relief?
So BPR usually applies to businesses that are actively trading, not passive investments. So if you've been running a shop, a factory, even a farm for at least 2 years, you could be eligible for BPR. The idea is to help keep those businesses within families
Okay.
and avoid a giant tax bill when the owner passes away.
Right. And what about the percentage of relief for BPR?
Mm-hmm.
Is it always 100%?
It depends, actually. It varies depending on how the business is structured and what kind of asset we're talking about.
Okay.
Example, sole traders and partnerships. They usually get the full 100% relief on their business assets.
Right.
But let's say you own some land that's being used by a partnership you're a part of.
Okay.
The relief drops to 50% for the land itself. And even shares in unquoted trading companies, those can qualify for BPR. It just goes to show it's really important to understand how your specific business holdings fit into these rules.
It sounds like there are a lot of little details to pay attention to here. You really got to know what you're doing to make sure you're maximizing these reliefs.
Absolutely. Every little detail matters. Yeah, it really can make a difference. And speaking of details, there's another layer we need to talk about. The time crunch.
Oh,
and
yeah.
these IHT changes.
Time crunch.
Oh! The new rules, they're set for April 2026.
But there's a catch.
Anti-forced stalling measures.
Anti-forced stalling. That sounds kind of scary. What is that?
Basically, it's the government's way of stopping people from rushing to transfer assets.
Okay.
Before the new rules kick in. Think of it like they're closing a loophole.
Right.
These measures, they start on October 30th, 2024, for any transfers made before then.
Okay.
But where the person making the transfer dies after April 2026.
So even if you try to get ahead of the game transfer assets before that April 2026 deadline, you could still get hit with the new rules.
Exactly.
If you don't live for 7 years after the transfer.
Right. You got to outlive that transfer.
Wow. Okay, so this time frame, it's really tight.
It is.
It really highlights how important it is to plan carefully and not rush into anything.
Absolutely. Informed decisions are key here.
For sure. Okay, let's switch gears for a minute. Let's talk about those CGT changes we mentioned earlier.
Yeah.
Those increases.
Right. Let's get into the specifics. What are the new rates?
Yeah, let's dive into those.
For higher rate taxpayers, the CGT rate on asset disposals is going up from 20% to 24%.
Okay.
And if your gains are within the basic rate band, that rate's going from 10% to 18%.
Okay.
What's interesting is those CGT rates are now the same as the rates for selling residential property.
So that means selling that investment property
Yeah.
or even that valuable artwork. Just got a bit more expensive.
It did. And for those who qualify for Business Asset Disposal Relief, BADR,
Right.
those rates are also going up from 10% to 14% starting April 2025. Then another bump to 18% in April 2026.
So a couple of increases there. What about that lifetime limit for BADR? The 1 million we talked about earlier. Any changes there?
No, thankfully that one stays the same.
Okay.
But like with IHT, there are those forestalling measures in place for CGT as well.
Right.
Any uncompleted transfers before October 30th, 2024, or any contracts for business disposals made between October 30th, 2024 and April 5th, 2026, but completed after April 5th, 2025, could fall under the new CGT rates.
Okay, so there's a lot to keep track of.
There is.
Deadlines, changing rates. It's a lot.
Yeah. With all this in mind, what should our listeners be doing right now?
Well, first of all, don't panic.
Right.
It's really important not to make any rash decisions.
Yeah.
Based on incomplete information.
Yeah.
We're still waiting on some final details.
Fair.
And rushing into things could actually hurt you in the long run.
So gather information.
Yes.
But don't jump the gun. What kind of information should people be focusing on?
You need to get a clear picture of your assets and liabilities. What property do I own?
What are the current valuations? You also need up-to-date copies of your will
Okay.
and any partnership agreements. This is crucial groundwork.
Time to do some digging, make sure everything is in order.
Exactly. And once you have a good grasp of your financial situation,
Right.
it's absolutely essential to get professional advice.
Okay.
Talk to your financial advisors, tax specialists, solicitors. They can help you create a plan that takes all of these changes into account.
So we're talking a holistic approach here.
Exactly.
Not just focusing on IHT or CGT in isolation.
Right. A good plan covers everything.
Okay.
From potential IHT liability and financing options to lifetime giving strategies and capital gains tax implications.
Right.
Even things like stamp duty land tax on property transfers and the potential use of trusts.
Speaking of trusts,
Yeah,
those could be kind of complicated, right?
they can be, but they can also be a really valuable tool
Okay.
for managing and transferring wealth. They offer benefits like asset protection and potential tax savings, but trusts aren't a one-size-fits-all solution.
Right.
It's about finding the right structure and approach for your specific situation and goals.
So getting that personalized advice is key.
It is. But I know some people might feel overwhelmed by the potential cost
Yeah.
or the thought of navigating all of this. What are some things they can do on their own to get started?
That's a great point.
Yeah.
It's understandable to feel that way. What would you recommend?
One of the most important things is to learn the basics of IHT and CGT.
Yeah.
There are tons of resources online,
Mm-hmm.
and even just understanding the key terms and concepts can make a big difference.
So knowledge is power.
Absolutely.
The more you know about these changes,
Mm-hmm.
the better prepared you'll be to make good decisions.
Exactly. And while we can't offer specific financial advice,
Right.
we're here to help you understand it all.
Yeah, it feels like we're kind of at a turning point here with all these changes coming up for IHT and CGT. A little bit of a wake-up call.
I agree, it can seem overwhelming at first.
Yeah.
But it's also a unique opportunity, a chance to really take stock of your financial strategy. Mm-hmm.
And maybe explore new ways to manage and transfer your wealth more effectively.
So instead of just reacting to these changes, we can be proactive.
Exactly.
Really take control of our financial futures.
Right. And as things change, it makes you wonder what new opportunities might come up.
Yeah.
For individuals and families who are trying to, make the most of their financial well-being.
That's a great question. It's not just about avoiding those tax burdens.
Right.
It's about looking ahead
Mm-hmm.
and finding those potential advantages within these new rules. We talked a little bit about lifetime giving strategies earlier.
Yes.
Could you expand on that a bit? What might that look like?
Of course, lifetime giving is a really powerful tool
Okay.
for managing your estate and potentially reducing your IHT liability down the road. There are a few ways to approach it. For example, you could consider making annual gifts of £3,000 per person.
Okay.
Those are exempt from IHT, so they won't be added to the value of your estate when you pass away.
Simple but effective. Are there any other gifting allowances that people should know about? Absolutely. You can also use the small gift allowance, up to £250 per person per tax year, completely free of IHT.
Okay.
And if you're feeling really generous, you can give gifts for special occasions like weddings or civil partnerships. There are specific allowances for those too.
Okay.
It's worth exploring these options and incorporating them into your overall financial plan.
So there are definitely ways to be strategic with your giving and potentially lower that future IHT bill.
Yeah.
What about other approaches beyond gifting? Are there things people can do right now to start preparing for these changes?
One of the most important things is to review and update your will.
Okay.
Make sure it reflects your current wishes and takes into account the new tax rules. You might want to include specific instructions for handling potential IHT liabilities or think about adding trusts to your estate plan.
And what about when it comes to selling assets?
Yeah.
What should people be thinking about with the CGT changes coming up?
Well, with those higher CGT rates, it's a good idea to be more aware of potential capital gains when you're selling things.
Okay.
So, for example, if you're thinking about selling an investment property or a valuable piece of art, you'll need to factor in that higher tax bill. It might be better to hold on to those assets for a bit longer.
Yeah.
Or explore strategies like holdover relief, which can defer CGT payments in certain cases.
That's really helpful. So it's all about planning, being informed, and taking those proactive steps.
Exactly.
Anything else you'd like to emphasize for our listeners before we wrap up?
I just reiterate that everyone's situation is different.
Right.
The best advice is always to get personalized guidance from qualified financial professionals.
Yeah, they can really help you create a plan that works for you.
Exactly.
That's great advice. All right, well, we've covered a lot of ground today.
We have.
But remember, knowledge is power, especially when it comes to your finances.
Absolutely.
Stay curious, stay informed, and we'll catch you on our next deep dive.